Let's move on now to our feature interview for today. And Australia is in the most recent period of growth and has become hugely reliant on Asia, in particular China. So what really is happening on the Chinese markets, and should we be bracing for significant slowdown? Today we have Jonathan Wu from the China Premium Fund, and he's here to talk to us exactly about what is going on in the Asian countries. Thanks for joining us, Jonathan.
Thank you, Julia.
Now let's start off with China. We've heard about China slowing down and how it's going to impact the world, and especially Australia. So what exactly is happening in China at the moment?
Okay, what China is going through at the moment is a period of transformation from being a very, a country with a high population of low-income earners, moving now to a very large population of middle income. And we're seeing this industrialization process, which we've seen happen before in Europe as well as the US, but now China is doing it the same way, except in a larger scale with 1.3 billion people. And I think people cannot ignore China's power, even from a share market perspective, because they are actually now 12% of global equity markets. And if we compare that with Australia, it's only 2%.
So China's absolutely massive, and I guess that's one of the things in its favour is the fact that its population is so huge. But we've seen a lot of signs that China is slowing down, and indeed a lot of companies' share prices falling off the back of that. So is China slowing down, and how significant is it?
Well, okay, to take into account, the first 3 quarters of growth for China was already in excess of 9%. When people are comparing China's growth of recent years of up to 12%, people I guess, frightened that China may go below 8 or 7%. And I guess what people need to take into account is that global growth now, even from the IMF perspective, is looking around between 2 to 3% next year. And if China does even do in excess of 7%, it's going to contribute a dramatic amount to the global growth figure.
But I guess if you're comparing a growth figure of, say, 11% to a growth figure of potentially 6 or 7%, that's going to have a massive impact on Australia's economy. So whereabouts do you see China's growth in 2009?
China's growth in 2009 will be focused on consumer spending. And that's exactly what the Chinese government's trying to boost at the moment. In late October, we had the president of China, Hu Jintao, come out and say to people that, present to the public that China's main primary objective going to the short-term and medium-term future is to ensure that China is well positioned to deal with its own internal problems before dealing with external problems. And that has come about through this new 4 trillion RMB or 850 billion Australian dollar stimulus plan coming into force.
Now, that's a massive stimulus package. So for investors that are looking at China at the moment, where do the opportunities lie?
Okay. Like if we say for the mainland Chinese market or the benchmark Shanghai or Shenzhen, it's gone down 70% from its peaks in September of 2007. And what people need to take into account is that valuations are now very low, and we've seen the fundamentals of these companies still remain very strong. If we take into account companies like China Mobile, they have 400 million subscribers already, and from here on in, next year they're looking at 40% growth in the number of subscribers. But at the same time, their share prices come down 65%. And people cannot justify why these valuations are so low. So the opportunities are actually there.
So Jonathan, I guess one of the things that troubles me is that when we have a look at valuations for China, they are low compared to the last 1, 2 or 3 years. But compared to global PE ratios at the moment, they're still at a relatively high level.
Yes, but going forward, you've got to also question is which region of the world is going to provide you with the growth potential that China can. If you have the US is obviously in a lot of trouble on its own, Europe is in the same place, and when you look globally, the countries and the companies which are going to come out of this crisis better are the ones which are heavily cashed up, as well as those governments and corporates which are lowly leveraged. So if you take into account China's been running a current account surplus for a very long time. They're running record trade surpluses, and also corporates in China, the average leverage is only 22%.
Now, Jonathan, I'm moving on from China, and I'm interested in a bit about your fund because it's won numerous awards and you concentrate on investing in China. What is your investment fund doing at the moment?
Okay. In terms of positioning?
In terms of opportunities, what are you investing in? What are you doing in terms of asset allocation?
In terms of where we focus the Premium China Fund, I guess our fund's mandate's very different to a lot of other China funds available. What our fund allows is that we can invest in any country or any stock that either has a majority of assets in China or derives a majority of income from China. So what we try to do is capture global growth anywhere we can. And what we're trying to do at the moment is position the fund into a lot of companies which have strong cash flow and still have focusing on the consumer story as opposed to resources, as opposed to materials. It's all focused on consumer spending as well as all these infrastructure projects that the Chinese government is rolling out and companies which will be beneficial to that.
So for investors who are still interested in the China story, what would be your message to them?
Well, again, it's the same message of you have to look around the globe at the moment for investment opportunities. You have to find which region's going to grow the most in the next couple of years, or really going into the long term, and which are the superpowers which are going to be, I guess, juggling for that top spot. And China's certainly in a very, very strong position.
So now you're positioning yourself with companies with strong cash flow, probably low levels of gearing and high potential for growth.
Yes.
But what are the risks to this model?
Okay. I guess not so much risk to the model itself, but your biggest risk to China as a whole would be still the polarization issue. So you've got a very small population of very rich people, and then you have a very, very large population of poor people. And that disparity, as it keeps expanding, or as this disparity increases between income levels, you actually would see a risk of civil unrest, because where do you set market prices? And I guess that is a significant risk, but the government is trying to deal with that at the moment by effectively, they've put in a plan as part of the 4 trillion to double disposable rural incomes by 2020.
We've run out of time, but Jonathan, thank you very much for your insights into China today.
Thank you very much, Shirley.
That's Jonathan Wu from the China Investment Fund.